Hello, good morning and welcome to ET Now's Buy Now, Sell Now with me, Varun Hiremat, and along with me, Karunya Rao. With that being said, let's now get a move on and look at the headlines for this Monday morning. And a lot has transpired over the weekend, especially with respect to the global markets, the Reliance future deal. So there's a lot of forces that are really influencing our market this morning. So let's walk you through the first one, RIL's retail acquisition of Future Group at a price of 24,713 crore. Every single future stock is on upper circuit as of this morning. So clearly a positive reaction seen there for the shareholders. Then again, something related to Reliance, but not specifically to retail. Geo Tower deal on the anvil. We have Brookfield getting the government nod to buy out the tower business for $3.4 billion. So this is another one that's got that counter in focus. And in fact, Reliance pretty much opened with a gap up on account of these two headlines. And moving forward to Adani and the meal deal, Adani takes over GDK airport debt and seeks MAIL control. So that's something that's got that group in focus, and this is something we had been speaking of. Then moving forward a little bit to banking this morning in focus, the NPA concerns. Moratorium ends today. So that 5-month interest holiday is now over. We need to begin resuming regular payments. So now we'll see how the asset quality holds up from here on out. Then moving forward, but sticking with banking, two different stories. One is Dinesh Khara has been selected as the next chief of SBI post the Honorable Rajneesh Kumar retiring. So it's not final at this stage, but it is the candidate who the board of SBI has put ahead and kind of approved. Then with RBL, we have Vishwahir Ahuja, who actually sold a fair bit of stock. So that's got that counter in focus as well for his own reasons. But this is something that transpired, which we learned over the weekend. And then finally, for me, before Karunya gets you guys a market check and some individual stocks, we have COVID gloom on account of GDP. The Q1 GDP numbers are going to be out today, and street estimates predict a 20% contraction in Q1. It could even be higher, but 19 to 25%, I believe, is the range among most brokerages. So those are the headlines. Over to you, Karunya.
Right. All right. Those were the top headlines to keep on your watch list. But talking about the markets, we saw a very, very strong open to both the benchmark indices. Of course, we've slipped down from those levels. In fact, Sensex also breached that 40,000 level on the upside. Right now, perched at 39,654 with a gain of 187 points. You have Nifty also firmly in the green. But like I said, it's cooled off a tad bit from the opening highs. Right now, above 11,700, but just above that level with a gain of about 0.5%. For the broader markets, we're witnessing some selling pressure, some profit taking perhaps after the massive uptick that we saw all of last week. You have small cap index down 1.2% and mid cap index is losing about 0.5% in trade. If you look at individual sectors and indices, you have a Nifty Bank which just slipped into the red, trading along the flat line, but the bias is towards the losers. Nifty Auto is down more than 1%. Nifty Media is down more than 2%. Metals and Pharma losing about 0.5% each. Some private sector lenders are also witnessing some selling pressure. But on the flip side, what's supporting the market is a Nifty FMCG, a Nifty IT, Nifty Realty. These are the names which are gaining quite firmly, the indices which are performing quite well in trade. From individual stocks, you have ONGC up almost 6%. Adani Ports is up 4% in trade. Infratel is up nearly 4% as well. There's IOC, Tech Mahindra, Wipro, HDFC Bank, GAIL, BPCL. A lot of oil and gas and stocks seem to be doing quite well. You have a Power Grid as well, up 1.5%. Coal India is up 1.5% as well. So these are some individual gainers. But let's pull up the BNS and stock cloud as well real quick to just see which are the stocks to keep on your radar today. RIL, of course, Varun has talked in detail about it. It's been in the limelight all through the weekend on back of that massive deal that they've struck with Future Group. So yes, RIL saw a solid opening, continues to trade in the green. You have Future Group stocks which have seen a very strong opening as well. Future Retail, Future Lifestyle, Future Enterprises, Future Consumer, Future Supply Chain. And yes, all of these will be eventually merged into FEL, and a significant chunk of that is something that will be acquired by Reliance Retail. Now, Bank of India, one of the key lenders to to the future group of companies is doing quite well in trade as well, after we finally have some clarity, we finally have some figures with respect to the consideration that the group will be receiving on back of that deal. You have an RBL bank as well. Varun was talking about Vishwi Rahuja offloading some shares, and that's the reason why the stock is in focus. Avocado, an earnings candidate, continues to hog the limelight. The numbers is something that's keeping the stock in focus. And you also have a Nestle, which we're keeping on our radar this morning. Some brokerage notes coming in as far as Nestle is concerned. You have Antique upgrading the stock to buy with the target of 17,935. So these are all the shares you need to keep on your radar in today's trading session. Back to you, Varun.
Right, thanks for that, Karanya. So much going on in the markets, and now it's really select stocks that are moving. But let's talk more technicals in market with Mandar Jamsandekar, and Ashish Kapoor, who are now with us. So good morning, gentlemen, and thank you for joining us on Buy Now, Sell Now. Mandar, let's come to you first. Technically, what's catching your eye this morning?
Basically today, the market is basically a consolidation market. So we have seen the last 5 trading days, the market has been moving up very strongly. And today, after the gap up opening, there is a bit of consolidation. So the market is cooling off today. And I think the day throughout would be a day of consolidation. Rest of the week, we could see strength coming back, but at least of today, there could be consolidation which will last for throughout the day.
All right, thanks for that, Mandar. And Ashish, good morning. What's catching your eye this morning in the markets this morning?
Well, I think markets have really run up very well, and in terms of the frontline indices, definitely markets have, I believe, overshot already. It has gone ahead of at least my targets. So one has to be very careful right now because there is some kind of a frenzy building up. The good thing is that the broader market is now doing well, and in the broader market, especially in the mid cap, small cap, and the PSU segment, there are good stock ideas which are still available. So yes, there are still some ideas which are available at very decent valuation. So one will have to be very careful, because overall the market has moved up a lot, and especially where the easy low hanging fruit has already been picked up. So from here on, it has to be very stock specific ideas, and ideas where your conviction is very high, and ideas where the valuation also is reasonable. Luckily, there are many such ideas. 2 such ideas which I can share with you. One is Bharti Airtel. Bharti Airtel has kind of corrected over the last few weeks, available at very decent valuation, is a good proxy to the digitalization theme going forward. One of the very few stocks where the earnings growth is still very visible and very decent despite the COVID situation. Also, the company has improved its ARPU, is improving its EBITDA. Every quarter is also going up on EBITDA margins. So technically, a lot of good things happening here, and the stock also luckily has corrected. So it's a very good entry point, in my opinion, for getting into Bharti Airtel. The other stock idea is RITES. Again, you're playing on the PSU theme, but RITES is a very asset-light model. The company is a leading player in the transport consulting as well as engineering consulting sectors. Company has been doing fairly well. The stock is available at a very low valuation. The dividend yield at the current market price is around 5%. So that gives us a very good cushion and downside protection. The company has a good proxy to the rail and the road sector, is also the export arm of Indian Railways. So I think the earnings trajectory is fairly consistent and likely to continue. And stock is available at a very low valuation with a good ROE and very good track record of increasing profitability. So I think this is one stock which investors can safely buy at this price. So these are my 2 stock ideas. But like I said, very important to be careful in the market now because the low hanging fruit has already been plucked. So from here, it has to be very stock specific ideas, and you have to be really careful of what you are buying and at what level you are buying.
All right, thanks for that. Mandar, back to you. What are the top trading ideas you have for our viewers today?
Yeah, I can hear you. Axis Bank, the stock had a resistance around those levels of 480, 490.
Okay, I think we need to reconnect with Mandar. We've got him on a bad line. Let's talk to Ashish then and address some viewer queries in the meantime. We'll try to patch Mandar back on the show. The first query is coming from Twitter from Bimal Kumar Shaw. He's based in Kolkata. He says he holds 400 shares of Tata Motors at a price of 208 rupees a piece. He wants to recover his loss and he's asking our expert advice in order to switch to another counter or another company wherein he can sort of recover the losses that he's incurred because of his investment in Tata Motors. Ashish, given that the stock is finally witnessing some uptake, the management commentary has been strong. We saw Mr. N. Chandrasekharan also talk about debt reduction plan of the company, going zero debt by next 3 years. Finally, we're witnessing some green shoots of their turnaround strategy also trickling in. Is it a good time to switch? Right now, he's incurring a loss of close to 60-70 bucks a piece. Good time to switch, or should he hold on to it for a tad bit longer?
I think you should hold on to it because the stock, like rightly said, has a lot of good things going about it now. The overall volumes are also doing well, and Tata Motors is getting good traction in the passenger car segment. Also, most important thing, like you rightly said, the group chairman has announced that this company is going to become debt-free in 3 years. Now, if Tata Motors becomes debt-free, then the stock valuation can really go up. So it might take 3 years, but you are quite likely to actually eventually end up with a good profit. So if you can hold on for 3-year period, I think that my best estimate is that Tata Motors would be trading much higher than even your buying price, because really speaking, the only thing pulling it down now is the huge leverage which Tata Motors has. Otherwise, on a turnover and other parameters, it is much bigger company than than its competitors like Maruti or M&M. It trades at a lower valuation mainly because of the debt. So if the debt issue is addressed, there is no reason that Tata Motors will not do very well from here, and I have no reason not to believe what Chairman is saying. So from my point of view, the investor should hold on and try and extend his time period. I think he will not only recover the cost, he will also make a good profit in this. As it is, Tata Motors, if you notice on a long-term basis, does always extreme valuations. It goes extremely high in bull markets and then extremely low in bear markets. It is a very high beta auto player. So having seen the downside, it is best to wait and see and catch the upside and make a good profit and exit. So my idea would be to hold on and try and extend your time period and make a good profit from this and exit.
Okay. Mandar, hi. Welcome back with us. We're talking about Tata Motors here. One of our viewers has written to us. He's holding on to 400 shares of the company. 208 was his buying price. He wants to exit it right now and perhaps look elsewhere at other companies wherein he could recover his losses. Ashish has a hold call because he believes that things are now starting to look up finally for the company. Going by the technicals, if you could tell us what's your view, because yes, it has significantly recovered from its March, April lows of 62, 63 odd rupees, right now at 145. Where do you see it go from these levels?
See, if you look at the long-term chart of Tata Motors, then the last 4-5 years, we have seen a clear-cut downtrend. This level of 100 was an important level for the stock. In the first quarter of 2020, we saw the stock dip below this level of 100, which was a bad sign on the long-term charts. But then the stock has shown strength and has managed to bounce back. So this is a positive thing that's happening in the on the stock chart right now. And I think with a 1-year view, the stock should head for levels of 200, 210. But if the investor continues to hold it with a long-term view, say 1 to 3 years, then the stock may also show us higher levels going forward. So 200 is an immediate target for the stock with a 1-year view. But with a 3-year view, the stock should head for targets of 360 to 420. And therefore, this is a hold with a stop loss at 98.
Okay, so Mandar being quite clear there and giving you guys fixed targets as well. Let's now move forward to our next query, which is a little more generic. Nitesh Kumar, he has proposed 2 stocks and wants to know which is the better of the 2. Lakshmi Machine Works or Schaeffler India. So I know they're a bit obscure names, we don't really hear of these, but Mandar, do you have a technical view on either of these stocks?
Yeah, see, if we compare the 2 charts, one thing is clearly seen that Schaeffler has got a positive undercurrent. So there's a strong undercurrent which has not allowed the stock to go through a deep correction. But whereas if you look at Lakshmi Machine Works, the stock from 9,000 levels has gone down to 2,000. So there has been a big kind of correction in Lakshmi Machine Works. So compared to this, going forward, if both the stocks decide to move up, we would see more strength in Schaeffler. So 3,500 is a support for the stock. On the higher side, 5,500 is a resistance. But as the stock moves up, the stock will be able to scale much more higher levels. And with a 3-year view, the stock should be able to head higher to levels of 8,000 to 9,000. So looking at both the stocks, the stock charts, Schaeffler looks more promising than Lakshmi Machine Works.
Okay, great, Mandar. Thanks. And Ashish, when you read things fundamentally, does Schaeffler still look more appealing, or does Lakshmi at this price look like a decent entry point to you?
Well, I agree that Schaeffler is a better idea because firstly, it is operating in a better industry. It is an OEM supplier, and auto industry is certainly in a better shape than textile, where Lakshmi Machine Works is supplying its machinery. So firstly, the user industry is in a better shape, so that's why Schaeffler should be better. Secondly, look at the track record. Schaeffler has been doing much better than Lakshmi Machine Works. Its growth prospects are also better. Operating margins are again better than Lakshmi Machine Works. And also at the ROE level, it does better than, it looks better than LMW. So on nearly all parameters, I think Schaeffler India is looking better than Lakshmi Machine Works. Is also an MNC backed by good technology support from the parent. So I think there is no doubt that Schaeffler should really be better from here, and that is where he should invest his money.
Okay then, Mandar and Ashish, thank you so much for joining us, sharing your picks and helping our viewers out as always. All right, we're taking a break here, but stay tuned as we return with an exclusive chat with Max India's Tara Singh Vachani alongside Nayantara Rai. Okay, we're cutting across to that right now. Let's hear out their conversation and then take a break.
Now, the Max Group has certainly been in the news. The promoters have a 7% odd stake left in Max Healthcare, which had a stellar debut on the Lal Street. Then Max India has been relisted as well. It in fact listed at 80 rupees and hit an upper circuit on Friday. Joining me to talk about the future of Max India is from the promoter family and director, Tara Singh Vachani. Now, Max India's core business is going to be senior living. It was the brainchild of Tara a couple of years ago when she started with residences in Dehradun. But now it's the core business of Max India, which is going to focus on the full spectrum of senior citizens. Residences, home care, maybe one day even financial services. Tara, welcome to ET Now. I've got to say double congratulations to you. What a commitment by you. Ladies and gentlemen, Tara had a baby just a few days ago, her second daughter, and she's here on ET Now to talk about her other baby, Antara, which, you know, is the core business of Max India. Like I said, hitting an upper circuit on Friday on the listing day. So double congratulations, Tara. You hit 80 bucks on listing. Were you happy with the valuation? You know, you hit upper circuits, that's all you could have gotten. But the problem is when you enter a sunrise sector is there's no peer-to-peer comparison. The market doesn't know what to compare Max India to at the moment.
Thank you, Nantara, for having me. And yes, it's been an interesting week of having a new little one at home. About the relisting, you know, the fact of the matter is there was also a little bit of a technical glitch when we relisted on Friday because the stock exchange essentially put a cap basis our last share price when we sort of went quiet when the demerger happened. So there's still a lot that I think that we're going to see in terms of the share price over the next few weeks and months as people start to understand what we're trying to do. And you're right, there isn't a comparison, but if you look at just the asset base and the value that Max India currently has between its capital as well as what Antara holds today, we see this share price having a lot more potential, which I'm sure we will unlock as the weeks and months come.
Tara, your father and the chairman of the Max Group has always been credited for identifying sunrise sectors. So he's always had this challenge of, you know, first entering a sector where the markets didn't know much about or were not enthused by, but then we have seen it grow. We saw that in the case of healthcare, the hospital chain. We saw it in the instance of life insurance, even with health insurance. Now the promoter family is obviously betting big and double downing on senior living. Why are you so enthused by senior living?
You know, Nantara, if you just look at statistics and you look at the demography of India and you look at the fact that we're 220 million people over the age of 60, there is no integrated offering for this 220 million. If you bisect from an income point of view, need point of view, urban, rural, all of it. If you even address 1% of this population, that in itself is going to be a mega trend, in my opinion. And therefore, it seems almost obvious just from a data point of view. And then, of course, intuitively, when you look around and you see the need for products and services for healthy, happy, graceful aging, along with the care and the lifestyle elements, it seems very obvious that this is, in my opinion, the next bet. It's going to take time. It's going to take a lot of execution focus, but we believe we can do it given the fact that, as you mentioned, we've not hesitated to play in, you know, new spaces and domains. And we've also now gotten 5 years of experience.
Yeah. Correct. How big is the market opportunity? Because, you know, from the large three's perspective, you're going to be the first listed player in this sector. How big an opportunity exists at the moment? Are you going to be in the full gambit, you know, whether it is financial services, home care, residences? Because you're also now clearly making a strategic shift. You started with these luxury and premier residences in Dehradun, but now you obviously realize you need to be city-centric too. So if you can take us through that.
Sure. So we've done a, you know, market estimation, and we've seen that it's a $12 billion industry already in India, but very fragmented. And when we looked at the value pools within that $12 billion industry, we realized we were already playing in one large value pool, which was our residences vertical, to which we're adding another project in Noida. And then we decided to add 3 more verticals within Antara, basis that value pool assessment. One being the care homes vertical, which are going to be 30 bedded units in urban India in neighborhoods, which is going to cater to the care element of seniors as we call them. care at home for people who want to continue to live in their ecosystem and they need services and products at home. And also we're exploring the medical devices space. So this is the game plan for the next 3 to 5 years. What more comes within this and after this is yet to be seen, but we're very focused on these 3 to 3.5 verticals, and we've already got pilots and proof on the ground for each one of them as I'm speaking to you today.
So Tara, if I go through the balance sheet and what has been disclosed at the time of IPO, there is, free liquidity of over 400 crore rupees. On top of that, you have assets. So obviously, you're well capitalized, well funded, and hardly any debt. What is the debt? So what is the growth plan then? What are you going to do with all of this money? Plus, you've got the IPO proceeds.
Right. So, the focus of this capital is towards Antara. We have done our 3 to 5 year planning with about a 300 crore allocation to Antara, to all of the 3 to 4 verticals I have mentioned. The beauty of this plan, though, is that we're now going asset light in Antara. So we will be able to continue to have the opportunity to pivot as we keep exploring and executing. So this capital is focused towards Antara and growing this space and really giving it all of our best to make sure we get to the right target audience.
Okay. Now also, so you're well capitalized, you're well funded, and you have very little debt. If you could tell us what that is. But if I could also see the, going by the past experience with the Max Grow, the formula seems to be that you enter a new business, you start it out, and then you get foreign joint venture partners, you also get private equity. Is that still going to be the plan with Max India, and senior living? Is that the way forward this time too?
So on your debt question, Antara, we currently have debt at the Antara Dehradun project level. That's the only debt we have. We don't have a debt at the Max India level because, like you mentioned, we're capitalized and we're going to use that capital for growing the various verticals. So the debt at Antara Dehradun project is being serviced by those sales, etc. So we're fine there. And as for joint venture partners, etc., it's too early to say. Because we have the capital and we have our game plan in place, we want to really be able to prove all of the things we've set out to do. And then who knows what happens, but we're definitely seeing interest in this space, and we'll wait and watch and see how it goes.
So you won't rule out the same formula of getting private equity players at sometime down the road, or even a foreign joint venture partner who has expertise in this?
Not at all. I think that, as we grow, it will always be helpful to have strategic partners, intellectual partners, but now is not the time. So as we evolve, we'll definitely be open to seeing how it goes.
Okay. Tara Singh Vichani, you of course saw the successful sale of Max Healthcare. The promoter family still has about a 7% stake in Max Healthcare, which also recently debuted. Look at the timing. The sale was, of course, announced well in advance of COVID-19. Give us a sense of when the promoter family talks about this, when Max India talks about this. You sold a robust healthcare business before COVID-19. We've seen so much activity now around the insurance space as well. And at a time when healthcare is clearly the buzzword.
Yeah. No, I think, Nantara, the truth is that, what you spend your life doing has to be pertinent to where you want your journey individually and personally to go. So there were multiple reasons why we exited that space. A lot to do with, the next generation and our aspirations in the space we wanted to play in. So we're very grateful the transaction happened. They're wonderful partners that are now operating the business and have really made it robust. So no regrets whatsoever. It was the right timing for us as a family, and our heart will always be connected to that business. And of course, we're very excited with all the opportunities that are coming ahead with the life insurance potential deals that we are doing, and we see a lot of opportunity there. So we feel good. We feel happy that things have progressed the way that they have.
So can I ask you what the synergies for Max India could be going forward? Like I said, in Max Healthcare, The promoter family still has 7% stake. I understand that's not strategic, but I would imagine with the new promoters, you have a good relationship, Abhay Soy. You've got the life insurance business where, you're going to do a deal with Axis. But the synergies are obvious with Max India. You can provide insurance to the senior citizens. You will need healthcare centers near the new facilities being put out by Max India. Are we going to see something like that?
We've always been very clear that Antara has to grow where there is good quality tertiary healthcare. And even when, we were thinking of other geographical locations where Max Healthcare wasn't, it was always going to be an imperative that we had partners. So for Antara, having healthcare and strong healthcare partners is going to be very, very critical. And of course, in the NCR and locations where Max Healthcare is, there will always be our preferred choice. And we have partnership agreements in place with them. We're doing a lot of things together, which is very exciting. And definitely we're also exploring with life insurance and health insurance products that is synergistic, but it's going to be open with multiple partners because that's the way we're going to be able to grow in various different locations.
Tara Singh-Vachani, we've run out of time. I'd like to thank you for taking the time out to speak to us at ET Now about Max India listing. We really appreciate it, considering you've just had your second daughter a few days ago, and in some sense it does show your commitment and how you're staying busy with your business. I don't know how you're managing both of them. That's a separate conversation I hope to have with you in the near future.
Thank you so much for having me, Nantara.
Welcome back to Buy Now, Sell Now. In what's been a major development over the weekend, Reliance Retail has acquired Future Group's retail business. The total transaction is 25,000 crore on the face of it, but it's a very complicated deal and the structure is not very simplified. But Karanya, who's taken a closer look, is now going to walk us through the fine print. Karanya.
Well, just to put it in simple words, what they've essentially done first, before they sell off the chunk to Reliance Retail, they have consolidated all the listed entities under Future Enterprises. Now, Reliance Retail will be picking up their retail and wholesale business along with their logistics and warehousing business. This is from Future Enterprise Limited. This will be on a slump sale basis, and the consideration that they will be sort of dispensing is 24,713 crore. FEL will be hiving off the retail wholesale business to an entity called Reliance Retail and Fashion Lifestyle Limited. It's a subsidiary of the company Reliance Retail. They will be selling logistics and warehousing business to Reliance Retail Ventures Limited. Now, essentially, what stays back with Future Enterprises is their manufacturing and distribution of FMCG goods and the sourcing and manufacturing of the fashion business as well. They will also retain their insurance JVs that they have with Generali, with the NTC Mills as well. Now, Reliance Retail will also be investing in this residual entity as well. As part of the transaction, they'll invest 1,200 crores via preferential issue of shares in FEL for a 6.09% stake, and additionally a 400 crore worth of sum in warrants convertible into shares, which after conversion will amount to around 7.05% stake. So by the time the deal finalizes, Reliance will end up owning between 6.09 to 13.14% stake in FEL, which is the residual entity that I'm talking about. So this is over and above what they're buying already from Reliance, from Future Group, which is their retail, lifestyle, grocery business as well. Key brands like Big Bazaar, like FBB, Easy Day, Food Hall, all of them will be dispensed to Reliance Retail. Of course, it is a very historic deal of our times as far as the Indian organized retail space is concerned. Kishore Biyani was the pioneer of Indian organized retail in many ways. He set up a very strong ecosystem, a very strong store footprint as well over the last 2-3 decades, and Reliance Retail is likely to benefit from it in a big way. They will get an access to close to 1,800 stores across the country, which means close to 28,000 crores worth of additional sales as well. Now, Reliance Retail, Future Group, it's not only, finally their exit from the segment, but also some good news coming in finally for their lenders as well. Given that the group has been grappling with debt issues for many, many quarters now. They have close to 15,000 crores debt payable to banks. They have about 7,000 crores worth of promoter pledging as well. So this will help them resolve and repay and settle their liabilities in a big way. Let's take it across to Ajay as well. He has compiled all the brokerage views coming in after the deal was announced on Saturday. Ajay, take it away.
Well, after being negotiated for several weeks, Reliance and Future Group deal finally has been sealed over the weekend, and most of the brokerages this morning are talking positive. CLSA, for example, says that it's a value accretive acquisition and Reliance will be able to go ahead and cement its position in the warehousing space as well. Similarly, JP Morgan says that the big just got bigger and scale and synergy benefits will start flowing in because of this particular deal. Not only that, some other domestic brokerages like Antique, etc., are saying that quite meaningful opportunities of economies of scale will likely to start pouring in. There have not been any big change in the target price, but clearly Big Bazaar strong branding will start flowing into the numbers going forward. And overall, even if you look at the valuation at which the deal has been done, according to most brokerages, they are saying that the 12-time EBITDA on FY20 actual basis, it's a very attractive deal which has been done, and it's a win-win for both the groups. So it'll be interesting to see how the street reacts to it. It may not be a market moving or stock moving given the size of the stock now, but if you look at the benefits which has been spoken about, most of the brokerages this morning are giving this particular deal a thumbs up.
Okay, like Ajay said, no matter how much it may or may not move the stock price right now, you have to understand the kind of entry it's giving Reliance into unexplored markets previously, or competitors' markets essentially. So thanks for that update. Brokerages seem to be quite upbeat on the stock, but changing flavor a little bit, we're now going to be on the 90th birthday of Mr. Warren Buffett. We are doing an interesting analysis here at ET now. And we're comparing him with a very other prominent investor called Soros, George Soros, who also is turning 90 this month, ironically. And let's take a quick view of their conversing styles, and as well as what their key achievements in their investing careers were. So both were born in August 1930. They turned 90 this year. They both started with zero capital. So that's the first common bond over there. None of them was given any kind of starting capital. They've both successfully, post this humble beginning, launched multi-billion-dollar funds. Warren Buffett needs no introduction. Neither does George Soros, but he's not as coveted as Mr. Buffett. Now, in terms of their worst losses that they've ever experienced, Warren Buffett lost $342 million in one day during the '87 crash. So that's his worst day in markets. George Soros lost $800 million in the 2 weeks of October '87. So his losses at that time were far greater than Mr. Buffett's. Now, let's talk about a generous streak in them as well. They both donated. Soros has donated over $32 billion. Buffett, on the converse side, has pledged 99% of his fortune to charity. So they're both big believers in the system and big believers in giving back. They've both written numerous books. A couple of books we'd like to bring to your attention for Mr. Buffett are Back to School. Another one is Essays of Warren Buffett. And for Soros, The Crash of 2008 and What It Means, and The Crisis of Global Capitalism as well are key books that we would like to highlight for you. So do have a, these guys have, obviously they're pioneers of the industry, and there's a lot of material out there on them, on their 90th birthdays, and in the case of Mr. Soros' birthday month, we'd like to just celebrate them both.